Hello, and welcome to the December Economic and Market Update presented by Commonwealth Financial Network. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. November was a good month for financial markets, extending the bounce we saw in October. The U.S. indices showed single-digit gains, but the biggest gains were abroad, with both developed and emerging markets up by double digits. Fixed income was also strong. The primary driver behind the continued rebound was increasing optimism that the Fed will slow its future interest rate increases. Inflation dropped across the board last month for the first time in a while, as energy costs pulled back and as other prices moderated, and as the housing market showed signs of slowing. Even Fed Chair Powell, in a speech on the last day of the month, acknowledged that the pace of rate increases was likely to slow. Rates followed suit, with the U.S. Treasury 10-year yield dropping from over 4% at the start of the month to about 3.7% at the end, a significant decline. Lower rates typically mean higher bond and stock prices, and that's just what we saw. Despite the improvement in inflation, though, we also saw signs the economy was still growing. Job growth remains healthy, driving increases in both personal income and spending. Business confidence also remains solid, and supporting this, corporate earnings, while they grew more slowly than they have been, did grow and beat expectations last quarter. So while the Fed's policies are working, so far at least, they haven't derailed growth. And that combination was good for markets, as with lower fears on rates and better than expected earnings, markets benefited twice over. That said, though, there are also risks in play as we close the year. While markets have weathered the midterms, politics remains a concern, and inflation could come back. And of course, risks outside the U.S., including Ukraine and China, remain very real. We're certainly not done with turbulence. But despite the headlines, last month's continued rebound suggests many of the risks may be priced into the market already, even as the fundamentals of job growth, spending, and corporate earnings continue to beat expectations. When the fundamentals are sound, the downside risks tend to be contained, which is where we are right now. And that's the bottom line. The downside risks are real, but we're increasingly moving past many of them into more positive territory. Market turbulence is normal, but as investors, we should keep looking at our long-term goals and not the short-term gyrations. And the long term does remain positive. That's it for this update. Thanks for watching. Join me next year for the next one, but until then, be sure to check my blog, The Independent Market Observer, for more timely comments. Stay safe, stay sane, and stay healthy. We are getting through this together.